Good morning, everyone. Welcome to the first Traction Financial Partners webinar of the year. We're excited to have all of you joining us this morning. Thank you for carving out the time to hear what we think is very important to each of us. And we'll go ahead and get started. Today's agenda is going to simply be Evan will spend a little bit of time talking about equity market returns over the past year, some anomalies there and some things that are unique, but just to make sure each of us has an understanding of that. I'll cover fixed income and current interest rates. Then Evan will give us the economic update with the latest data that is available, and then I'll provide a little bit of perspective before we wrap it up. So I'm Bob Heykoop. I'm President and CEO of Traction Financial Partners, and Evan Barnes is my business partner and also founded the company with me, and he's our Chief Investment Officer. So thank you again for being here today, and we look forward to going through this with each of you.
Thank you, Bob. We are going to jump in here. Let me get us to our correct slide. As we are getting to the equity market overview, quick reminder in the question and answer box. If you have questions along the way, we're going to pause at the end and review any of those that you may have. And so in the question and answer area, please type your questions in and we'll make sure we get to those. It was another very solid year in the stock market for especially U.S. stocks. And so that's back-to-back years. 2022, quick reminder, we saw that bear market, okay, a 20% drop in the S&P in 2022. That's when inflation was over 9% in the summer, and the Federal Reserve started to increase interest rates to slow down the economy and fight inflation. So we had a tough year in 2022. 2023, we had the natural recovery, and 2024 kept that going. So if you look at the second column from the right, 2024, Dow Jones last year did 15%. S&P, another solid year. S&P 500, the 500 largest stocks in the U.S., 25%. NASDAQ 100, which is the third one down there, up 26% in 2024. The NASDAQ is primarily growth-oriented stocks, tech stocks. Those types of guys are in the NASDAQ 100. And then if you look below that, S&P 500 growth and S&P 500 value. We've seen this theme here now for a few years. We're going to talk more about those growth stocks in particular. But the more risk-on growth type of stocks, tech stocks, have done really well over the last few years. And that continued in 2024. S&P 500 growth up almost 36%. The value up 12%. Okay. So again, that disparity over time, different asset classes, will be the winner, but we've seen a few years in a row here with growth being that winner. In the middle, we're going to have the S&P 500, S&P mid cap 400 growth and value, followed by the S&P mid cap 600 growth and value. Similar story, but these are the mid and small size companies here in the U.S. And the theme continued where we saw growth outperform value, 16% on the mid growth, a little over 11.5 on the mid value. Small cap stocks were in the single digits last year, growth doing a little better. All right. When you look at the Russell 2000, so this is the broad-based small and mid-sized stock index, and the Russell 2000 up about 11.5% in 2024. So we're going to go into a few slides here that the larger stocks in the U.S., the mega caps, the big ones, those have been the drivers in the market the last few years. Mid and small size stocks still performing, but not quite to the level as the larger stocks in the U.S. What has been an underperformer, and you've probably seen our memos from the investment committee over the last week or so, if you are in one of our investment models, we're doing our semi-annual rebalancing. We do a rebalance in January, typically do one in July. It's important to keep you in your proper allocation from a risk perspective, to sell high, buy low, those types of things. And one of the things we are doing during this rebalance that has been going on this week is that we are reducing our exposure to international stocks. We believe as an investment committee with a new administration and just how things are working around the globe, geopolitical issues, growth issues that we see overseas, that we think that the U.S. is going to be more of a focus in terms of growth. And so we reduced our international exposure in our portfolios, and we'll obviously continue to monitor that, but we think that's the right move for the time being. If you look, MSCI EAFE, which is Europe, Australasia, and Far East, that's the fifth one from the bottom. That's the broad-based international index that covers the developed countries, and it did 3.82% last year. Okay, so again, very muted. If you look at the second from the bottom, the emerging markets, that's going to be China, India, Brazil, the BRICS countries, about 7.5% last year. So again, international stocks hanging out in the single digits. Finally, at the bottom there, commodity index. When you're looking at energy, precious metals, agriculture, that type of stuff is going to come into the commodity index, and that's 9.25% in 2024. So those were the 2024 returns, something that we like to look at because investing is long-term. And to keep that perspective is if you look under the 5-year column on the far right-hand side, that brings in, we had COVID in there. You also had 2022 pullback, and you can still see the annualized returns across the board are all positive. Okay, so sticking with your strategy, sticking with your investment objective is important over the long haul. Because the markets tend to recover, and when they do, you want to make sure we're participating in that. Okay, left-hand side, if we're looking at what parts of the economy and the stock market perform well based on the sectors, okay, so you can break down the stock market into these different sectors. Left-hand side, top 3 are going to be growth-oriented type of sectors. Communication services, think of Facebook. Technology, Apple. Consumer discretion, think of Amazon. So the big stocks helping drive those parts of the stock market, those sectors. 38.9% on communication services, tech did 35%, consumer discretion did 29%. The best value performing sector was financials. Towards the end of 2024, after the election in particular, the idea that regulations could be pulled back, in particular on the finance industry, that helped propel some of those returns in the fourth quarter on financials. If you move further to the right, we have some of the sectors that struggle. Okay, so you had energy at 2.4%, real estate coming in at 1.3%, healthcare 0.9%, materials actually ended down for the year. Real estate, for example, had quite the choppy year. Okay, so it was very flat for the majority of 2024, had a decent third quarter with the expectation that the Fed might start cutting interest rates. And they did, and we're going to talk about that. But despite that interest rate cut, market interest rates, mortgages, those types of things actually did not drop. And the fact that those rates did not come down hurt real estate towards the end of the year. So that's some context there to why that particular sector didn't do well. On the right-hand side, I'm not going to spend a ton of time on this because we just mentioned it. If you look on the right-hand side, okay, that's the growth column. Upper right-hand corner, 33.4, that's large growth. You go down, mid cap, small cap, blend in the middle. Okay, so more like an S&P 500 would be that blend in the upper middle category at 25%. Value on the left-hand side. So you can see again, just what we talked about on the previous slide, growth in each category did better than value. And the large cap stocks did better than the mid and the small cap stocks in 2024. Question that we get nowadays because of 2023 and 2024, the solid returns in the equity markets is now a good time to invest? Are stocks too expensive? Is this a good time to jump in? It's a good question because you want to make sure that historically you want to buy low, sell high, that type of stuff. But over time, the market does continue to increase. And when we look at our valuations, are stocks expensive? The best way that we think to look at that is the PE ratio, the price to earnings ratio. Basically, how much does it cost per dollar of earnings for these particular stocks? Okay, so for example, in the upper left-hand corner, the current PE ratio on large cap value stocks is 16.2. The 20-year average is 13.8. If we move further to the right, the blended stocks, a mix of growth and value, the PE ratio at 21.5. The 20-year average is just about 16. Growth 28 versus 19. So that comparison, when we look at that, is we are having to pay more per dollar of earnings, okay, for these particular categories than we do historically, at least over the last 20 years. So stocks are more expensive than they have been. Does that mean it's a bad time to invest? Not necessarily. Bob has a great slide here in a little bit from a market perspective standpoint on investing at all-time highs and how that actually tends to work out well over time. Again, this doesn't mean that stocks are too pricey. It's just you're paying more for them because they've continued to go up over the last few years. The nice part is, I'm going to show you here in a minute, is that the profits and earnings of these corporations is actually backing up, or at least for the most part, backing up what the prices have been doing in terms of going up. There is some reasoning behind the increase in the value. When we look at the mid and small cap stocks, though, the price per earnings versus the 20-year average, they're definitely a little closer. The growth side is still more expensive. If you look on the right-hand side, for example, mid cap growth 28 versus 20 on the 20-year average, but they're a little tighter than when you look at the large cap stocks, because if you're looking for value and getting in maybe at a lower price, mid and small cap stocks are still a little bit more attractive than large stocks when you're looking solely at that. Okay, for mid and small cap stocks to really pick up and do well, the economy has to keep growing. Likely interest rates need to come down because mid and small cap stocks tend to borrow more. Okay, as you borrow more at higher interest, that tends to be more of a struggle. So if interest rates come down, there could be some value there in the mid and small cap stocks. All right, just ended that slide talking about mid and small, but we're going to talk about the mega cap stocks here now. When we look at this slide, the Magnificent Seven we've referenced multiple times throughout our last few webinars. And these stocks continue to help drive the market. So when we look at the Magnificent Seven, we're talking about Apple, NVIDIA, Microsoft, Amazon, Alphabet, which is Google, Meta, which is Facebook, and then Tesla. So on the left-hand side here, when we look at the size of these stocks when compared to the S&P 500, so these 7 stocks out of a 500 stock index, how much of the index is made up of these 7 stocks? How big are they? You can see in 2024, when you add the size or the market cap of all of these combined, it's about 30% of a 500 stock index comes from 7 stocks. Okay, so they are big, and when they move the market. That has increased from just in 2020, these 7 stocks, they were still big, but they came in around 22% of the S&P 500, and now they're at 30. Okay, so when you see the earnings reports come out for NVIDIA or Amazon, these guys, there's a lot of focus on those when those come out from a market perspective. And when you consider how big they are and how well they have done the last few years, it makes sense that a lot of the gains in the S&P 500 have come from those stocks. And so on the right-hand side, if we look at the S&P 500 index 2024 attribution, what part of the return percentage-wise of the S&P 500 came from these 7 stocks. So if the S&P did 25% last year, and you look here, NVIDIA, for example, big semiconductor chip maker, really big into AI space. NVIDIA last year made up 5% of the 25% rate of return on the S&P. Okay, Apple did 2%, Microsoft was almost 1%, Amazon contributed 1.5%, Meta 1.33%, Google 1.3%, and Tesla at 0.88%. So again, of a year where the S&P did 25%, all other stocks, 493 stocks, made up 11.5% of that return, meaning that those 7 stocks made up for more than half of the return on the S&P last year. Okay, so we wanted to make sure we added some context to, hey, it's a good year in the market. We all like it. We appreciate it. Our account value should be increasing with the market. These 7 stocks have really driven the car the last few years and helped out in a big way in terms of returns. It could reverse in 2022 when we had a bear market. Those 7 stocks had a tough year. Okay, so if we see that kind of reversal and how big they are and how much they impact the S&P 500, that's where we want to see returns spread out and come from other areas of the market and not just be so focused on those 7 because it increases your risk. Okay, this is pretty interesting. When we look at the percent of the S&P 500 members that outperform the index itself. So meaning that if the S&P did 25% last year, how much or what percent of those stocks, of those 500 stocks, actually did more than 25%? Okay, which ones outperformed the actual end return on the index? Last year, 28%. So only 28%, a little more than a quarter of the stocks last year actually did more than 25% on their individual returns. Again, those big 7, the returns that they did helped the market go up. But there's still a lot of stocks out there that did not outperform that 25% number. So again, looking for better attribution from other parts of the stock market. The nice thing is in the second half of the year, we did start to see other areas start to carry some weight and pick up on the return side of things when it comes to not just be so heavy on the tech stocks. All right, and so I referenced before when it comes to the PE ratios and how expensive stocks are and whatnot, the backing of that is, hey, maybe I pay a little more for this particular stock, but the earnings of that stock are backing up what I'm paying for. It's actually rewarding me for even paying a little more than I used to from a PE perspective. And what this is showing us is that if you look at the last couple of crisis or market triggering events that cause a lot of volatility on the downside, you can see on the left-hand side here, the tech bubble. Okay, so right around the turn of the millennial. Financial crisis of 2008, COVID. Okay, and you can see what percent of stocks in large cap, mid cap, or small cap were unprofitable. Okay, so in the tech bubble, for example, 28% of large cap stocks weren't making a profit. 32% of mid cap stocks, 41% of small cap. Okay, financial crisis looked a lot like the tech bubble. Okay, COVID was a little bit of a different animal just because of how quickly it happened and the circumstances around shutting down the economy and whatnot. But large cap stocks, only 20% were not profitable during COVID. The small and mid cap ones were the big ones that struggled during COVID. That was about half of those stocks were not profitable. Okay, so if we look at where we are sitting currently, we're in pretty good shape, especially on the large cap and the mid cap side of things. Only 7% of large cap stocks are currently not profitable. Okay, compared to 20%, 29%, and 28% in some of these other examples, companies are being profitable. They're making money, and that's a great thing. 16% on mid cap compared to the other ones that we see on the screen here. Small cap stocks historically there's always been a good chunk of small cap stocks that are not profitable. So that's an important piece when we're looking at investing in smaller companies, that we have some type of active management there to say, okay, we know that there's a good chunk of these companies that aren't going to be profitable. So we don't want to invest in a huge index that's going to have 2,000 stocks. We'd rather have a smaller concentration in more profitable stocks. And that's something that as an investment committee, we're constantly looking at and tracking in terms of how are we being active in areas where we can find a little bit of inefficiencies and better companies. That's it from the stock side of things. We're going to let Bob jump into fixed income and some of the key interest rates.
Okay, so as we pivot to talking about fixed income, there's a number of things on this slide that's very interesting. I'm going to start on the far right side. If we look at the last 5 years of U.S. Treasuries, intermediate maturity Treasuries, Ginnie Mae, 30-year mortgage-backed securities, U.S. bond aggregate, corporate yield, high yield, corporate investment grade, municipal bond, and the global aggregate. I suspect all of you see that the returns that we are getting from fixed income over the last 5 years, either flat or negative. So bonds did not perform the way bonds have historically performed, but that's improving. We look at the next column, 2024, it's certainly much better as we see those returns giving us some reward for the risk that we're taking in the bond market. The only one that's still lagging is global bonds. And there's, again, as Evan mentioned earlier, the global markets, both developed countries as well as emerging markets, have lagged what the U.S. economy and the U.S. markets have done. One thing to point out before we move on. So this was calculated through the 3rd of January. So when we look back on 12 months from the 3rd of January of 25 to the 3rd of January of 24, look at the difference in the U.S. Treasury intermediate rate or return between 2.42 and 2.84, and that is really just six days. 3 days lost at the beginning of, and actually 2 days because the first is a holiday, but the 3 days lost at the beginning of 24 and the 3 days gained, that's significant. And when Evan was covering equity returns, it was the same, a substantial amount of return when we looked back 12 months over just the calendar year of 2024, which speaks to the importance of not trying to time the market, staying invested in the market, because really that only included 4 trading days. Okay. Key interest rates. A lot has happened in 3 years. If we start again at the column on the right, the 2-year U.S. Treasury short-term treasuries were yielding less than 1%. 10-year treasuries, 1 3/4, 30-year 2.11. In Germany, it was negative. The international rate, the SOFR, was flat. The Euribor rate, the 3-month rate, was negative substantially. The 6-month CD rate was flat. The 30-year fixed mortgage, which many of us in the economy got drunk on buying homes and refinancing when we could get a return of our interest rate of sometimes less than 3%, but certainly under 4 for a period of time. Fast forward to today, look at the 2-year Treasury, the 10-year, the 30-year, the German bond, the SOFR, the 3-month, 6-month, 30-year fixed mortgage, which we haven't gotten an update yet, and the prime rate has all slowed down. Some things in the economy on the borrowing side, but on getting a yield that many of us were used to prior to COVID, is a little bit more encouraging, and we're going to chat a little bit about what's going to be happening going forward next. So this slide is a little busy and has a number of key things on it, but it talks about the federal funds rate expectations. And the market is always trying to anticipate what the Fed is going to do with monetary policy. If we go back and see what the Fed funds rate was during COVID, it was 0. And you can see that right there in 2020. Then they started a rate hiking cycle that was very steep. And that cycle ended in September of this past year. So there's 4 things here we want to look at. What the current federal funds rate is, what the year-end estimates that they've provided in Chairman Powell's comments, what the market expects, and then what the Fed is projecting in the long run. So some key things here is we ended 2023, the federal funds rate was 4.38%. 24, I'm sorry. Thank you, Evan. The year-end estimate for that same period of time was 3.9%. So clearly they were off pretty substantially between what it actually ended at and what their previous estimate was. If we look at the green, I think that's probably the key is how the market has reacted. So regardless of what the Fed has said, the market is expecting both through this year and into the future, a federal funds rate of somewhere right around 4%, slightly under 4%. Yet the Fed gave us estimates of ending 2026 at 3.4% and dropping down to 3%. So there's almost 100 basis point spread between what their projection is and what the market is saying will happen. Many people probably aren't aware of this. In 2024, almost $4 trillion of US Treasury debt matured. So what happens when debt matures? They have to refinance it. They have been refinancing it at a much higher rate. Hence the reason you saw the yields on the treasuries substantially improving over what we saw just a couple of years ago. 2025 will be very interesting because over $6 trillion is scheduled to mature, and that has to be refinanced. And clearly, with current rates, that's going to be refinanced at a higher number. So it makes the treasuries look much more attractive to the investor, but it also creates a much larger debt liability to this country, which is really cause for concern as we look at this going forward. Then you can just take a look at what matures going out from here into the future. And it'll be interesting to see what happens with the new administration, with the new Congress, with the Fed, and what the monetary policy will look like going forward from here. So those of you that remember back in the day, if you took statistics class, this is just a quick lesson in statistics on fixed income. The gray bars are the range of yields from the best to the worst. If we look on the left side of this chart, these are the major sectors, US Treasuries, municipal bonds, investment grade, corporate bonds, mortgage-backed securities, collateralized mortgage-backed securities, and the ABS, as well as the Euro investment grade bonds. You can see the yield. There's quite a range. If, for example, just in municipals, they were as high as 7.5% and as low as 1.5%. The purple bar in the middle, that's the 10-year average. The current yield is at 6.3%. So almost every one of these sectors in the fixed income markets is above the 10-year average, which, as we mentioned earlier, we're seeing bonds perform back to the way bonds have performed historically. Okay. All right, we'll push it back to Evan now and give you a little update on what's going on in the economy.
Thank you, Bob. And this will piggyback on what you were mentioning when it came to treasuries maturing in 2025. There was 6 trillion that is coming off the books that will need to be refinanced at higher rates. And so when we look at the federal finances, the components of the budget, and we look at 2025 federal budget, on the left-hand side here, you can see the total spending at about 7 trillion. Okay. Where does that come from? The biggest chunks come from Social Security and Medicare. Okay, so Social Security is about 22% of the budget. Medicare is about 16% of the budget, so 38% between the two of them. You add Medicaid on top of that, so you're over 40%, over 45% of the budget comes from the major services through Medicare, Medicaid, and Social Security. Okay, and you have other mandatory spending, defense spending. Okay, so defense spending is about 14% of the budget, or 964 billion. I'm going to draw your focus down towards the bottom, the net interest. So as Bob mentioned, the interest that's paid on our debt is actually more now than defense spending. Okay, so we're looking at over $1 trillion in net interest, 15% of the overall budget, where defense was 14%. And that difference is likely to be higher, because if you look on the right-hand side, okay, how do we fund it? How do you fund the government? Income taxes make up about 37%. Payroll taxes at 25%, corporate taxes 7%. You have some others in here at 3%. So that's not enough. That's not enough to pay for all of our obligations. So you can see in the upper right here, our deficit, almost $2 trillion. Okay. Tariffs do bring in, and we'll talk more about tariffs here in a second, about 1% of the funding would come from tariffs, but we have to finance the rest of it. And if we have 6 trillion that's coming off the books, and then we have another 2 trillion that we're adding on top of that, so call it 8 trillion for this year in terms of new debt issued by the Treasury to help fund our government. And we're doing it at interest rates in the 4s, as opposed to the average may have been around 1.5 or 2 before. The obligation to cover that debt, the cost of it's going to be a lot higher. Okay, so that's something that internally as an investment committee we're watching very closely, and that we continue to talk about how is that going to affect interest rates, how is that going to affect yields and bonds, because although the Fed, as Bob mentioned, started to cut towards the end of last year, market interest rates, mortgages, those types of things actually went up, stayed flat or actually went up. And that could be directly correlated to, as a portion of that would be the fact that we have to continue to borrow as a country. And so as our debt continues to go up, we have to finance it at higher interest rates, and that's going to continue to keep rates a little bit higher than we otherwise would have anticipated. And so that's something that we want to make sure that we're on top of. In addition to that is inflation. We're going to talk about it here in a second, which is another reason that interest rates could stay higher, is because inflation might be stickier than originally thought. But when we look at where GDP comes from, so the growth in the economy, we had another decent year in growth. We'll see what the actual numbers were here in a couple of weeks for the overall real GDP for 2024. Should be around 3%, I think, is kind of the estimate. But when we look at our economy, okay, the share of GDP of where our growth comes from, and it's been this way for a long time, we are a consumption-based economy. About 70% of our GDP comes from what we buy and consume. Okay, business investment, government spending, exports, those types of things all play into it, but we are very much a consumption-based economy. And so if the consumer is strong, if the consumer is healthy and spending continues, that tends to mean the economy does pretty well. That's why there was some concern in 2022, 2023 around the Fed increasing interest rates the way they did was, is that going to slow down consumption? Is that going to slow down the economy? It was necessary because of inflation, but the consumer was the main part of the economy that we were focused on. Is, hey, are we still spending money? And for the most part, we did. Where that's coming from is a different story. Mostly the higher income earners continue that spending, with inflation eating away at purchasing powers for the middle class and below. That's where we saw some major issues where debt started to creep back up. But as an overall economy, spending stayed strong. And who's spending? Okay, Gen X and millennials. Gen X and millennials are driving the economy. When you look here in the middle, folks from age 35 to 44, 45 to 54, a lot of that is that Gen X and millennial age group. And that spending is continuing and being strong. Baby boomers, for the most part, are getting into retirement if they are not already there. It's not on this chart, but something that will be happening over the next 15, 20, 30 years is that the largest transfer of wealth in U.S. history will happen from the baby boomers to their beneficiaries. Okay, and so this is where spending is coming from. Tariffs is a big topic of conversation these days. Okay, throughout the election, we had a lot of conversation around tariffs. You hear what Trump's proposing and could possibly implement. And while there's concerns around tariffs, is because tariff is just a tax on imports, which would make those goods and services more expensive, right? That cost to be passed on to the consumer. That's the theory, and that's how it should work in action. If you look historically, we used to be a real tariff-based economy, going back into the 30s and into the 40s. Okay, so back in the day, we had tariffs on a lot of products and goods and services. Over time, free markets opened up, more global trade, those types of things, and so you saw the percent that came from tariffs drop dramatically. Pop back up here in the last 4 or 5 years. Trump did impose tariffs in his first term. The Biden administration kept those going. On the far right-hand side, so the question is Trump actually going to implement the tariff policy that he was running on, where he would do a 20% universal tariff and a 60% tariff on Chinese goods? If that's the case, we jump right back up into the 1930s types of tariffs. Okay, I think we would believe that's probably more of a negotiation tactic if that's kind of how his first term went. And there was news earlier this week that they were saying, hey, the tariffs are going to be more of a slow implementation. So we don't believe that it's going to be as aggressive as this chart would show if everything was implemented at once. But it's absolutely something we're watching, because with increasing debt and deficits, with the economy still doing well and the consumer spending and tariffs, that's kind of that inflation concern, that inflation might be stickier and not be going down. If inflation's sticky and doesn't decrease any further, that means the Fed may not cut as much as previously anticipated, like Bob showed us on the Fed estimated cuts going forward. Because if inflation doesn't continue to go down, or at least ease, those rates are going to get cut, and the stock market won't like that. All right, I believe this is the last slide on the economic side of things. Our economy over the last 10, 15, 20 years, definitely more of a tech-focused economy, and that has really accelerated the last few years. Artificial intelligence is a big deal. It's not going away. It's going to continue to be implemented throughout the economy, not just in the tech world. You may not even know you're using AI. If you Google something, the very thing the deal that pops up at the top of a Google search, that's their artificial intelligence piece that's answering your question. On the left-hand side here, you can see capital expenditures, how much money the major AI hyperscalers are spending on data storage and AI investment. And Alphabet, Amazon, Meta, Microsoft, Oracle, those are some of the bigger hyperscalers. And on this chart, you can see the percent of operating cash flow and capital spending that's going to be going towards artificial intelligence is going to be jumping big time over the next couple of years. It took a big jump in 2024. Same thing in 2025 and 26 is the expectation. When we are watching earnings reports come out, the market tends to like it when the CEO or whoever's doing the presentation talks about how their particular organization is going to be implementing AI. That is something that the market wants to see. That's something that the economy is going towards. On the right-hand side, you can see a big spike in U.S. industrial production in the tech world, especially after the CHIPS Act. Okay, so after the CHIPS Act that was passed in 2022 and new investment going into semiconductors and chips, the computer equipment, communication equipment, semiconductors, all of those spiked, especially post the CHIPS Act. All industrial expenses have kind of been flat over that same period of time. Okay, so when it comes to spending, it's very much on computers, technology, and artificial intelligence. All right, we will end with some market perspectives, and I'll turn it back over to Bob.
Thank you, Evan. One thing is we wrapped up talking about AI. I had the privilege to go to a conference a couple years back, and the chief technology officer for NVIDIA was presenting and talking about AI and the implementation going forward and the amount of spending, research and development going on with AI, but he also provided a little perspective. He started in the industry in the late 70s, and he was one of the key people that helped develop AI in the early 80s. It was on the space shuttle. And so AI has been around a long time, but you've never heard it spoken about more than it has been recently. All right, so as everyone should be aware, we're in a bull market. First year of the bull market, and again, this is a historical average. It goes back all the way to 1946. And this was through the end of October of this past year. But the first year of a typical bull market, which is right around 6 years, usually gives us the highest percentage return. I think that can kind of be obvious because in a bear market, the market has lost value. Clients haven't necessarily, and people invested in the market haven't lost money because it's simply on paper, but the value of their assets have gone down. So that first year return makes some sense. Second year, which is really what we were in this past year, the average historical return in a bull market is 15.2%. As we're approaching this year, third year, you can see typically the third year gives us the least amount of return. And we believe, as we've discussed, that this year will be certainly muted compared to the last 2 years. But years 4, 5, and 6, if we continue to be in a bull market for the next 3 years, give us above average returns in the S&P 500. Evan alluded to this earlier. There are times where we all are like, when should we be in the market? When should we not be in the market? When's a good time to invest? Should we dollar cost average? This puts a little perspective, again, going back 25 years. Excuse me. If you look at any 3-month rolling period, 6-month, 1 year, 2 year, 3 year, 5 year, if you chose to invest a lump sum of money on any given day, whether it's a small part of your portfolio going in on a regular basis or it's a single investment, if you invest on any day, the average return on a rolling basis over any 3-month period is 3%. If you invested when the market has hit an all-time high, like it has this past year, it's hit an all-time high 57 trading days in 2024. If you look at a 6-month rolling basis, it's almost even. Whether you decided to invest on any given day that the market was open and make trades, or you waited until you invested at a new high, we saw 6.1%. 1 year is where this kind of starts to flip, where any given day underperforms what investing at a new high is. So let me pause there before I go on to just remind everybody that it seems counterintuitive to invest when the market is high. When clients that we've worked with for decades decide to invest some money because they've sold a home, they've sold a business, they've got a little bit extra on top of what they've already invested, they always ask, when's the best time to go into the market? And we always say today, because you don't want to miss the best days, just like I spoke about earlier. At the same time, if you look historically about just being in the market, so time in the market is what it's referred to, that has always over time outperformed trying to pick any day. If we go now to 2 years, if you invested any day over any rolling 2-year period back to 1950, the average return has been 25.3%. If you invest on a day where it's hit an all-time high, that's outperformed any given day, 28.9%. The 3-year, you can see the spread gets bigger between 40% and 46%, and then all the way to the 5-year where we've seen a spread of 6%. So be encouraged that if you want to invest for whatever reason, whatever the purpose of the money is, whether it's short-term, intermediate-term, long-term retirement, that every day is a good day to invest. But if you choose to invest on a day when the market has hit a new high, well, certainly that's going to reward you. Again, back to statistics. The further we go out, the better or more encouraging this chart looks. On any given 1 year, back 75 years again, the difference between the best year in the S&P 500 or stocks in general was 52%, and the worst year was minus 37. If you look at bonds, best year 33%, worst year 13. And if you look at a 60-40 portfolio blend of stocks and bonds, 34-20. If we look at any 5-year rolling period, no matter what year you start, no matter what year you end on a rolling basis, this looks significantly more encouraging. 29% on the upside with stocks and only a 2% downside. If you take a look at the bond side of things, 18 and minus 2, and then a 60-40 portfolio in any 5-year period has never lost money, and the best year has been 20%. If we go out a rolling 10 years, so if you have been investing for 10 years, if you anticipate you're going to need to be invested for 10 years more in the future, regardless of what your age is, this is something that you should take into account, because stocks historically have given 11.6% return on average during the same period. Bonds 5.2 and a blended portfolio 9.4. And rarely, if you own stocks, does the market value of that portfolio over 10-year rolling period ever become negative. And when it was negative, it was only 1%. And then to the 20-year, so if you're 60 years old and you anticipate being invested and needing to generate income for your retirement, you can confidently invest if you look even just at a 60-40 portfolio. So not getting aggressive, that's probably the most common portfolio that investors over the age of 50 have, is a 60-40 portfolio. Their best year was 15% and their worst year was plus 5. Okay. This kind of speaks to thinking about stock picking over the overall market. And it gives you an indication, and Evan spoke to this earlier, gives you an indication of what returns have looked like back to 95 in the S&P 500. So what the price return of the S&P 500 index was, which does not include dividends, and the number of stocks that ended the year down 5% or more. It really lines up with all the bull markets and bear markets. But from 95, we saw 34% of those stocks invested, that's the return of the stocks. I apologize. On the top chart, 34% was the return. Then we saw 20, 31, 27, and 20. Then we had the dot-com bubble, where the market lost 10, 13, and 23 in 3 successive years. I always like to point to the average. If we look at the average return without dividends of the S&P 500, that's a 10.5% return. But we also have to be realistic and keep in mind that we are going to have those down years. So in a period of 30 years, there's only been 8 years where it was either flat or there was a negative return. So that goes back to what we've spoken about in previous webinars, that 75% of the time, the S&P 500 ends in positive territory, even if it's a little choppy during the year. And 25% of the time, we get to welcome a small loss in our portfolio if we average it over time. Then the bottom lines up very well with what Evan shared before. Just talks about the number of stocks in the S&P 500 that had more than a 5% loss in any given year. And you can see there again, that lines up where the overall loss of the price return of the market was, the greater the number of companies that ended 5% down or more. It will be interesting to watch going forward with the Magnificent Seven, what we see happening. But if we go all the way to the right side of that, you can see, again, the average is 148 companies over the last 30 years have had a loss of 5% or more. The last 2 years, it's been under that long-term average. So back in September, the Fed ended their hiking rate cycle. And this slide just kind of tells us what we've seen after they end rate hiking when you compare CDs, the US bond aggregate, the S&P 500, and again, the 60/40 portfolio. So the year after, the 12 months after that cycle ended, so we can use September of 24, you can see in almost every situation, in every asset class, whether it's CDs, which really is considered cash, US bond aggregate, S&P 500, and a 60/40 portfolio, the following 12 months, with the exception of 2000, all gave us substantial return. So again, we like to take the data, and of course, history and hindsight, like I said, is always 20/20. But this puts us in perspective, because we saw the CD rate finally go up for the first time in 3 years, and the returns that we anticipate or we hope to see again will all be positive in all 4 of those categories.
All right. I think that will do it for us. I'm going to click through to the disclosures, which Bob will read very slowly.
There you go.
All right. We'll leave that up here. But this is going to be available on our website. We're also going to email it out to everybody that was on, as well as other clients who could not participate. So if you get that and you thought this was valuable and that you think someone should listen to it, please go ahead and forward that on. I don't see any questions in the Q&A at the moment. Let's see if there was any in the chat. Does not look like it. So we'll pause just here again for a minute, see if there's any questions that come in. But I think that we wanted to summarize the webinar here. We were cautiously optimistic for this year. Companies are still making profits and earnings look solid. We are concerned about interest rates to a certain extent not dropping the way that the Fed or the market had anticipated, based on what the Fed was going to do with interest rate cuts starting in September, like Bob mentioned, with higher debt deficits, tariffs, economic growth by itself maybe being more than anticipated. That might impact inflation and what they do with interest rates. But overall, we're still cautiously optimistic. The third year of a bull market, like Bob said, can be a little choppy. We've had 2 back-to-back years of 20+% rates of return on the S&P. So, it's not appropriate to expect that that's going to continue to happen every single year. But hopefully we added some context to what's going on in the market and the economy and what you can expect to happen this year, but also always bring it back to, hey, what does your financial plan look like? Make sure that's being updated. We are investing based on your plan to help you accomplish your goals and objectives. And so that's always what we bring it back to is, hey, we want to help you accomplish those goals and objectives, and we'll do so based on this information and also many other factors that could play into it. But double check the question and answer again here real quick. Does not look like there's anything in there at the moment. I think we'll stop it there and wish everybody a great day and a good weekend. And so we will always be here for questions. And if you need anything from us, please feel free to reach out. Again, this will be on the website and will be emailed out to you, but that will do it for our webinar today.
Thank you.